Hello, everyone. I hope your day is going well so far. My name is Joseph Ejike Oji, and today I'm going to keep you company briefly. Yeah. Um, Today we'll be working on two things, actually three things. There will be financial securities, financial institutions, and then investment funds. I will start by sharing my screen so you can see what what we're doing here. Hope you can see my screen now, I believe. Yep, I think you can see it right now. Now, um, again, the three topics we will be covering tonight will be, today will be financial securities, financial institutions, and then investment fund. So let us begin. So the financial securities, this simply means some pieces of papers with contractual obligations. So those that hold that pieces of papers are entitled to some specific right or claims on some specific cash flows. So now what it means is this: when you have those financial securities, you have right or claim to some cash flow. When I mean say cash flows, I mean things like money coming into you based on the fact that you hold those securities. Money can come in the form of dividend for shares, interest for bonds, or capital gain for shares. So those obligation or claim or entitlement that you have as a result of being holding any of these financial securities are what I mean by cash flow coming in. So they are just pieces of papers with contractual obligation that entitles you to some specific right and claims to some cash flows in the form of dividend, interest, or capital gain. Now we have three of them, three major types. We have the debt instruments or debt securities, equity or stocks, and then of course derivatives. Now debt securities or instruments. Now a debt security, we call it debt security because even though it is debt, it brings in some cash flow to you. So when you buy them, you are lending money to an institution, which can be a bank, a company, or even a government. So a good example, we have things like bonds, like US government bonds. We have certificate of deposits. We have commercial paper and debentures. Now the bonds, we also have corporate bonds. So bond, when you buy bond, you are lending money to an institution and they will pay you interest or coupon. We call it coupon every 6 months. In some countries, every year, depending. So government use bonds to borrow money from the public when they want to do some projects like build new roads or rural electrification or any other project that they want to do. Another one is companies can borrow, sell bond in the capital market if they want to raise money to do some projects. For example, when Apple want to do a new project, maybe develop a new phone, for example, they might sell bond to raise cash from the public and usually do research and development, for the new phone and then produce new phone. Now, when they produce that phone and market it well, and the sales start coming in, they can pay back the bond, the bond holders, when the bond matures. Sometimes some bond mature within 1 year, some 5 years, some 10 years. But within that year, those years, the holders of those bonds will be receiving some payments every 6 months, or we call it coupon payments. Eventually, we'll do bond as a topic, but I just want to show you that kind of investment security, what they are. Then certificate of deposits and commercial papers, and then debentures. All these are also debt securities. The certificate of deposit, we popularly call them CDs. when you buy them, usually they are sold by banks. So when you buy them, you are lending money to the bank for which they will pay you at maturity. Now, because CDs are very safe, their return are very small. I will show you with a few examples for some banks. Excuse me. I have let me see. I have this. Yep, can see some CDs. This particular one, Marcus, is 6 months CD. The maturity is 6 months, and the return is 25%. Ali Bank, return is 0.240%. This one is 0.25%. So you can see that the return is very small, not even up to 1%, because of the fact that they are very safe. So if you put a large amount of money there, you just if you are rich, put $1 million in any of this. That means you just relax for 6 months. They give you your money back plus the return or interest. Now, commercial papers, just like CD is a form of another way companies can borrow money at a short-term basis to do a project. Now, let us go to the next type of financial security, which is called the known as the money market security. Well, we call them money market security because there's a section of the financial market where financial instruments that have high liquidity and mature at a very short time are traded. So those securities that are traded in those section of the financial market, we call them money market instruments. Money market, the simplest way to explain it is that it's a market for short-term securities. Securities that mature within a year. We say short-term, it means securities that mature within 1 year or less. Now, so we can in money market we can trade certificates of deposits, commercial papers, which are basically short-term securities. Companies use this to borrow money for to do a project in a short-term. So when they sell the commercial papers to you, when you buy them, you are lending money to the company, and they pay you within 1 year. I mean, assuming that the company didn't go bankrupt. So the return on commercial paper are much better than CD. Yeah, but then the CD are cheaper than the commercial papers. So they are typically issued by large banks, and corporations to cover some short-term receivables or meet some of their short-term financial obligations, like funding a project. Now, next one is treasury bills. These are also a money market instrument. Usually last for 3 months. Let me show you an example of treasury bill. The U.S. Treasury bill is the safest in the world, and because of that, the return is very little. So let me show you the U.S. Treasury bill. If you come here, you can see. Let me take you to Treasury Direct. Direct.gov, okay? All right. So if you are a private individual trying to invest, you can see the where you can put the money, treasury bills, treasury securities, and you can see the returns. See treasury bills right here. You can see the return on treasury. See the minimum amount to invest is $100. So it's easy to invest, and then the return is let me see where they have the public returns. So I'll use the rates in recent auctions. You can see the return for 13-week. 13-week, you can see the return is investment to the point to actually this one mature in 13 weeks. Okay. But what I'm looking for is treasury bills. These are all treasury. I think these are all treasury. Yeah, they're all treasury bills. Security term. But you see, none of them mature above 52 weeks. So you can see the returns all here and the day they will issue. Let me show you with this one. The security time, let's see, 26 week. Okay. All right. So now it didn't give us much information here, but when you explore this website, you see a lot of information about it. I just wanted to show you where their returns are. You can see right here. Okay. Now back to our discussion. Okay. Now another one is bankers acceptance, which is also a money market instrument. A bank acceptance simply means just like a post-dated check. When you give somebody a check to be paid in the future, just like that, it's similar to that, but not exactly like a post-dated check. So it's simply an order for a bank to pay somebody or an institution at a later date, at a future date. So the difference is that a post-dated check cannot be traded, you know, but a banker acceptances can be traded. Is often usually those that are involved in import and export use banker acceptances. So the only different from this instrument, the only way it differs from a post-dated check is that um, it is an investment, unlike and it can be traded, can be bought and sold. I can buy a banker acceptance, an investment, and resell it to somebody else and make gain. That's the only difference. We have equity. This is another type of financial security. Equity. Equity simply means stock. So different companies have their stocks. If you want to be, when you buy a stock of a company, that means you become one of the owners of the company. For example, if you want to be one of the owners of a Walmart, all you have to do is go and buy their stock. And you can buy their stock in many ways. This is not like the old days when you have to go and talk to a stockbroker. Not anymore. I mean, you can still talk to a stockbroker if you want, but there are so many trading platforms or brokerage websites where you can buy stock. Some place like Fidelity, Robinhood, and so on. There are plenty of them. What I want to show you is this. I want to show you how the stocks looks like briefly. Now I'm going to take you to Yahoo Finance. So you can see, let's say Yahoo Finance. Okay. Now suppose you want to buy the stock of a credit company, or you want to research a company. Then you can come here to see how much the stock price is. Let's say we are using Bank of America, okay, as an example. Bank of America. Okay. I think the symbol is BAC. BAC. Let me try BAC. That should bring it up. Yep, that's bringing up Bank of America Corporation. So that is the trading symbol. You can see right here. So the stock is sold for $39 per share. So if you buy 100 of this, that should be like 3,969. So that means when you buy 100 of it or more, then you become one of the owners of Bank of America. So that if Bank of America declares a dividend, you will receive the dividend. So equity means shares and stock. That's what it is. So that's what I wanted to show you. So now any company wants to buy the share, become one of the owners of the share of the company. Okay. Then we have derivatives. Derivatives are not share stocks per se. They are securities that derive their value from something else. So we are going to do more on these derivatives, a lot of work on them in future. But when you buy derivatives on stocks, you don't really own the stock. You're just borrowing the stocks. You're not trying to make money using them. So you don't own them, but you own their derivatives. Good example are options and futures. So we're going to do options eventually in this class. For now, just know that it is a type of investment that derive their value from other things. For example, an option can get a value from the stock of a company, or an option can get their value from maybe a commodity like oil. You know, let me see if Bank of America have options that I can show you. Let's see. Bank of America. Let's see it has options here. See, look at the options, and then you can see their trading, their prices. See all the options they have, the call options they have. See, you can see their strike price and the last price they traded, and so on and so forth. Okay. Now, again, like I say, we are going to come back to options and discuss it more elaborately as the derivatives. Which lead us to the next thing, financial institutions. The financial institutions, well, we call them financial institutions because they are establishments that focus on or that deals with financial transactions, such as investments, giving out loans, and accepting deposits, plus other things that they do. So we have many of them. But in summary, they include things, investment banks, savings bank, sorry, I'll call it savings and loans associations, credit union, and commercial banks. Let's start with investment banks. An investment bank, yeah, just 1 minute. An investment bank simply focus on, or well, their main job is to conduct or to do some financial transaction like investments in stocks, asset management. Sometimes they do that. Mainly investing in stocks and bonds and other securities, then giving loans and charging interest on those loans, then accepting deposits from customers, for safekeeping. Now, I think I already mentioned it. Now let's look at investment banks. The main role of investment banks includes helping companies to raise capital. They help a company to raise capital. For example, if a company somebody wants to do a project, let's say that Apple or even Amazon want to do a project and they needed money, they can raise capital using the investment banks. Or, for example, I'll give you another example. Let's say that some years ago, Facebook used to be a private company, but then they wanted to go public. So what they do, they went to an investment bank who helped them to float the shares, advertise the shares, so that more people cannot buy the share and invest. So with the money that Facebook raised, they can be used to expand their operations. Today, Facebook is so big, as much as almost 2 billion people subscribe to Facebook. So investment bank help companies to raise capital. Sometimes even an old company, a company that has been in existence, let's say Ford Motors, and they want to do maybe these days this is an era of electric cars. So let's say that Ford want to expand their go into a building of electric cars, and they needed more money. They can raise more money by creating new shares and selling them in the capital market, or by selling bonds. So investment bank can help them do that. So they also provide other advisory and consulting services, that things like merger and acquisition analysis and other things that they do. Example, we have many of them, but one I have here is JP Morgan and Company, the Bank of America's Merrill Lynch, and Savings and Loan Association. These are just like basically like any bank, any commercial bank, and so that they have they're more of localized, in what they can do. So They are financial institutions that specialize in accepting savings, deposits, and making loans, mortgage loans, and other loans to their customers. So they are different from commercial bank in just that the way they are chartered. They are chartered by either by the Office of Thrift Supervision of the state, or any of the states government financial regulatory division. That is in US. In other countries, I think they have other countries have their system. They have their agents that regulate banks and how they are chartered or registered. Yeah. So when I say charter, I mean kind of license, giving the bank somebody an institutional license to operate as a bank. That's what I mean by charter. So the savings and loan are chartered either by the Federal Office of Thrift and Supervision or by the state government financial regulated division. In contrast, commercial banks receive their charter from Office of the Controller of Currency. I'm talking about in US here. In other countries, they have their own different financial or agencies that give banks license to operate. So the Office of Controller of Currency is under the division of the US Treasury. Now, another way they are different is this: most of their customers tend to be at the local level. Commercial bank is like nationwide, but savings and loans are usually localized to maybe maybe a county or just a state. We are within a state. So we have example. We have the Arundel Federal Savings Bank in Glenburn, Maryland, and Somerset Savings Bank in New Jersey. So which lead us to credit unions. Well, these are banks, but they operate like a cooperative societies. They operate like a non-profit actually. So the simplest way to explain what it is that there are cooperative associations whose members have a common bond. That common bond can be maybe they are employees of the same firm or the same company, and so on and so forth. Now, in a credit union, like I said, it operates almost like a cooperative society, like a non-profit financial institution controlled by its members. So they deposit money on it. Now, the way they gain is that the regular bank are run by shareholders, and the goal of those shareholders is to make money, through capital gain or dividend. But for the credit union, their goal is just to help the members. I would say, let me put it that way, in form of low interest. So the profit they make, from their business, they give it back to members by way of charging them favorable interest rates. So if a member want to borrow money from the credit union to buy a house, I can. If the credit union is charging a non-customer, let's say 5%, the customer might be charged only 2%. Stuff like that. That's why they call it, that's how the members gain from it. So a good example, we have a Maryland State Employees Credit Union. And commercial banks. These are the type of bank that everybody knows. They have branches nationwide, and sometimes even worldwide. They offer all the services of that we know at the bank. What we call bank actually are what any bank that offer this kind of services at the commercial bank. Things like accepting deposits, giving business loans and auto loans, mortgage lending, offering basic investment products like savings accounts, certificate of deposit, etc. Now, this good example, we have a Bank of America, Citibank, M&T Bank. There are lots of them. Which leads us to the next thing in line, which is the investment funds. So the simplest way to describe an investment fund is that it is a supply of capital belonging to numerous investors that is used to collectively purchase securities while the investor retains ownership and control of their shares. Now, a good example of this is the mutual fund, hedge fund, and private equity fund. Now, mutual fund is this is simply means a pool of funds collected from many investors, and then the goal is here is to, of course, to buy different securities like stocks, bonds, money market instruments, all kind of securities. Now, so let me explain in the simplest way of this. Now, if you have $5,000, for example, or even $1,000 that you want to invest in the stock market, if you use that money to buy a stock of Bank of America or a stock of Ford, that means you're investing your money, that $1,000 in only one company. See? So if that company goes bankrupt, you lose your money. So, but in a mutual fund, if you invest $1,000 in a mutual fund, they will spread the investment. They will invest in different companies. So there's no way all of them will fail. So the same $1,000 that bought you only one stock can buy you so many stock of so many companies if you invest in a mutual fund. So, I mean, that $1,000 might be even invested in. I will show you how this works. Now, let me use an example of mutual fund. Okay, let me see. I think I have this. Okay. Let me show you this mutual fund. I'm gonna share. Oh, I made a mistake. Okay. Yeah, I'm gonna put it right here. So let's see. Oh, in that case, what I'm gonna do is this. I'm gonna use zero price, because this is not letting me copy it from here. Okay, I'm going to use zero price. Now, before I do that, let me explain something else. Now, good example of mutual fund, we have like Masons and the zero price. So I'm going to use zero price, as an example to show you how mutual fund works. So I'm going to take you back here. How is it? Zero price. Okay. T price. Okay. So suppose you buy this company sells mutual fund. Let me just put it that way. Now, so they see let me see their products, the funds, and we can view all the funds. You can see how much. Let me make sure you're seeing all this. Okay, good, very good. So you can see where you have all the fund right here. See the mutual funds. So if you look at the mutual fund, and it will bring us here the funds performances, the mutual funds. See all mutual funds. Okay. Let's assume that we'll be looking at. Let's choose stock fund. Okay. For example, it has so many of them. Okay, stock fund. Now, under the stock fund, we have different kinds. We have the Africa Middle East Fund, All Cap Opportunities Fund, and so on and so forth. Suppose we use other kind. Let's see, we use. You can choose any one of them. It doesn't really matter. But I want to show you something here. Equity Index Fund, for example, or external equity index fund. Can be anything. Now, suppose you decide to invest in a financial services fund, for example. I click on that. So let's just see what the fund is composed of. Okay. Okay. So you use your $1,000 and then put it in this financial services fund. Okay. And this is the portfolio, what you have. That $1,000 will be spread, and it will be invested in Chubb Bank, Wells Fargo Bank, Bank of America, Signature Bank, and American International Group. Just $1,000 will be spread. So even if Shop Bank or Wells Fargo fail, you still have your money here. In Bank of America, you still can make money from there. Unlike when you put out 1,000 in one company alone, whereby if the company fell, you fell. Okay. So now let me show you another fund. Assuming that you decide to put the money in this fund, it's coming in. It's a little bit slow, but you gotta be here. Assuming you want to put it in a balanced fund. Okay. Let's say you want to put it in a balanced fund. Okay. $1,000 in a balanced fund, and then they will spread the money into this all this fund here. So let me open the portfolio. See, it will be in Alphabet, that is Google, Microsoft, Amazon, real estate, Apple. Their $1,000 will be spread on this fund. If it's $5,000, it will be spread toward this fund. So why instead of having only one stock, you have different slices from different companies. Another way of saying it is not spreading your investment, not putting all your eggs in one basket. Yeah. All right. So I think you get the point. So let's go back to our work here. Okay. Good. Now, next is the other type of fund. Give me 1 minute. Let me pull it out. The other type of fund we have is the another type of investment fund we have is the one we call hedge fund. A hedge fund simply means, well, just a name, a fancy name we give to investment partnership. So it's just like it is when two, in the partnership we have, in my previous lecture we discussed partnership. When we have different types of it: general partner, limited partner. General partner do all the work, just like the manager. Then the limited partner only invest and stay away from the actual running of the business, but he get the profit. When the business profit comes, he get a share of the profit. So in a hedge fund, you have a marriage or a kind of partnership in form of investment partnership, whereby there's a mixture of the general partner, fund manager, general partner who is the fund manager, and the investors who is the limited partner. So the two of them, I have it a general partner, that's the fund manager, plus the investors who they put their money. They don't get involved with the running of the partnership. They just invest and then wait for the profit. So the limited partners do all they contribute money, but the general partner manages it, according to the fund strategy. Now, hedge fund can they can maximize investors' return and eliminate risk, but they take a lot of risk though. But there's a way they handle it to make sure that that they minimize that risk. When I say that they take a lot of risk, they can invest outside the box. You can invest anything. They don't invest only in stocks. They invest so many things. Now, as you can see from our next, you see some key points about hedge fund. So unlike mutual fund, which has thousands of small investors that can invest. As a matter of fact, anybody that work in US that have full-time job have 401k, and that 401k is actually money that they put in all kind of mutual funds. Anyway, unlike mutual fund, hedge funds are limited to the institutional investors. Either you are an institution or you are a high net worth individual. That means you are very rich, maybe millionaire, that they can allow to invest. Yeah. So small investors don't go to hedge funds. Yeah. It's large investors, institutional investors. Now, also, so that means investors in hedge fund have to meet certain net worth requirements. That means if you're individual investors, at least a net worth that exceeds $1 million, excluding their place of residence. Now, they invest in anything. They invest in hedge fund can invest in land. They can get involved in with land speculation and all kind of things, or they can invest in real estate, stocks, derivative currencies, even Bitcoin. They can invest in that too. But mutual funds stay away from something. They don't invest in land. I mean, they can invest in assets that a company that have real estate, but not buying the land, physical land itself. So they usually stick to stocks and bonds. So a good example of hedge fund, we have the Bridgewater Associates, we have the BlackRock, we have Goldman Sachs Asset Management, and so on and so forth. Okay. Now, next is the private equity firm. A private equity firm, basically what they do is this. Well, it's like a venture capital firm, basically. So what they do is that they see a private company, even a public company that is not doing well, they can borrow so much money, what we call in finance parlance, we call it borrowings to invest. We call it a kind of borrow money and then use it to buy another company. It's called it leveraged buyout in finance parlance. So you can borrow so much amount of money, buy the company that is sick, then fix that company. In some cases, they can break it into 2 or 3 different companies, fix all of them, sell them off for more profit. That's basically the summary of what they do. So, in order to achieve their goal in this regard, we have a private equity fund. Usually have in addition to fund manager, a group of corporate experts who can be assigned to manage the acquired companies, make sure that they are run the right way, so that they become profitable, and then they can sell it off, make so much money, and then pay back the bank. Okay, so that's basically what private equity firms does. Examples we have things like Apollo Management, Golden Gate Capital, Kobag, Gravis Robots, and Benz Capital. So now, this brings us to the financial market. Now, financial market, this is a topic we'll cover in our next lecture. So today we'll be dealing only with financial securities, financial institutions, and the investment fund, like the fund I mentioned, mutual fund, hedge fund, and private equity funds. I hope you enjoyed the lecture. Again, my name is Joseph Ejike Oji, and thank you for listening. And I will see you in my next lecture.